Hi. Let's learn about the follow-on public offer, FPO. A follow-on public offer is when a company listed on the stock exchange issues additional shares to investors. This typically happens after the initial public offering, IPO. Follow-on offerings are also known as secondary offerings. Public companies can take advantage of an FPO through an offer document. FPOs are different from IPOs, as they are additional issues made after a company is established on an exchange. The proceeds from the sale of FPO shares go directly to the issuing company. Diluted follow-on offerings occur when a company issues more shares to raise funding, which can decrease the earnings per share. The funds raised are often used to reduce debt or change a company's capital structure. Non-diluted follow-on offerings happen when existing privately held shares are brought to the public market for sale. The cash proceeds from non-diluted sales go directly to the shareholders placing the stock into the open market. An at-the-market offering gives the issuing company the ability to raise capital as needed and depending on the prevailing market price. This type of offering allows for minimal market impact. Follow-on offerings are common and provide companies with a way to raise equity for various purposes. However, shareholders may react negatively to secondary offerings as they can dilute existing shares and may be introduced below market prices. Companies often raise more equity through FPOs to improve their debt-to-value ratio or finance new projects for growth. ATM offerings allow businesses to raise capital quickly without having to announce the offering and typically require minimal management involvement. ATM offerings may be smaller than traditional follow-on offerings, and the price may fluctuate depending on the market. In summary, a follow-on public offer is a way for a publicly traded company to raise additional capital by issuing new shares to the public. This can be done to fund new projects, pay off debt, or increase working capital. FPOs can be dilutive, where new shares are added, or non-dilutive, where existing private shares are sold publicly. Overall, FPOs are a way for companies to tap into the capital markets and raise additional funds without taking on debt. Here are 4 key takeaways. 1. A follow-on public offer, FPO, also known as a secondary offering, is the additional issuance of a company's shares after its initial public offering, IPO. 2. Companies usually announce FPOs to raise equity or reduce debt. 3. The two main types of FPOs are dilutive, meaning new shares are added, and non-dilutive, meaning existing private shares are sold. 4. An at-the-market, ATM, offering is a type of FPO by which a company can offer secondary public shares on any given day, usually depending on the prevailing market price, to raise capital. Hope this would help. Thanks for watching.